Inflation, everybody's favorite topic of conversation. That's what we're going to dive in here on today's video. So, why are we talking about inflation? Well, I'm sure you're hearing a lot about it in the news, and so let's dive into it and see what kind of impact that might have on markets and really the economic recovery going forward. So, this is timely because tomorrow on Thursday, we're going to see the CPI report, the Consumer Price Index report, come out. And a lot of experts, a lot of analysts are estimating that we are going to see inflation north of 4% year over year. Now, that is an extremely high number if we just take it by itself, but the key here is that the market actually expects that high number, so it's not going to be really much of a surprise. The key, though, with inflation, as it has been going back all the way to fourth quarter of last year, is whether or not inflation is a temporary thing or if it's more structural. So if inflation is in fact temporary, as the Fed thinks it is, then the outlook for equities and bond markets, and really a lot of markets, is extremely positive, because in that scenario, the Fed continues to stay dovish in their approach, meaning the Fed would allow inflation to continue to gather momentum, and that is fantastic news for equities in the near term. If, on the other hand, inflation is more structural and not transitory, then the outlook is much, much worse, because at some point the Fed is going to have to get hawkish in their approach and do something to combat rising inflation or hyperinflation, which means higher interest rates, which generally speaking leads to lower stock prices. So, what's the big $1 million question here? How do we tell if inflation is temporary, transitory, or if it's more structural or more long-term? The key here is to watch what's called inflation expectations. And the reason I think that's important is because as consumers and investors expect structurally inflation, as these investors and as these consumers expect inflation to be around for a long, long time, then what's going to happen is that's going to create, just from a behavioral standpoint, those investors, those consumers are going to want to lock in prices now, which means that we get more cash chasing a very finite number of goods and services, which in effect creates inflation by itself. And so it's almost as if this hyperinflation can actually be sped up simply by investor behavior. And so that's why I think it's important to look at these inflation expectation reports, especially the consumer reports. Here's the bottom line with this, though. If inflation expectations continue to tick up and stay elevated, that's the key. If they stay at those levels, then inflation is absolutely not a temporary thing. At that point, it would be very clear that inflation is more structural. And again, I think the outlook in that scenario is not very good. So, what are some metrics to look at here? Well, number one, you want to take a look at the 5-year TIPS and the 5-year Treasury's break-even point. And TIPS stands for Treasury Inflation Protected Securities. And what that report shows is that is the bond market's estimation of annual inflation over a 5-year rolling period. Now, the current state of affairs with that particular metric is that inflation expectations are still at a multi-year high when we look at that 5-year rolling average, but lately they have effectively been chopping sideways over the last 2 months. And for those wondering, yes, I'm sweating. It's summertime here in the South, and it's extremely humid, so bear with me. All right, so that's the first report. And again, that is the 5-year Treasury Inflation Protected Securities and Treasury break-even. That's the first report. The second report is what's known as the University of Michigan Consumer Sentiment Inflation Expectation over a 1-year period. And so, again, the importance here is looking at what consumers actually perceive inflation to be doing. And there are a lot of experts out there that claim that metric is the only pure measure of consumer inflation expectations. So if we were looking at this and we wanted to have a warning signal, so a warning signal would be that we see inflation with this particular report rise above 3%, actually rise above 3.5%. Again, key question, will it hold at that level? And if it does, then that would imply that inflation expectations are becoming ingrained at the consumer level. So that's the second report we look at. Third report is the University of Michigan consumer sentiment inflation expectation over 5 years. So very similar to the report we just talked about, except it's over a 5-year period. And there are a lot of experts and analysts out there that claim and argue that this is the most important metric. Why? Because if consumers start pricing in high inflation over a multi-year period, then the effect of that can cause persistent inflation. Just like we talked about before, that behavioral aspect of it, investors get this sense that they have to lock in prices now, and it creates a buying frenzy with a finite number of goods and services, which in effect creates inflation. So if that were to happen, if we see this persistent inflation environment, then that's going to cause the Fed to take drastic action. And the one thing that they will do in that scenario is they would hike rates, which again, if they start raising rates, that's going to lead to pretty severe market volatility. So the warning sign with this particular report that we're looking at is, again, above that 3% mark and holding, right? I think that's the key. If it shows that it is holding at that level, then again, that goes back to investors feeling like inflation is becoming more structural and it's ingrained in their mindset. Now, what's the good news here? The good news here is that from a long-term standpoint, on that 5-year report, inflation expectations remain below 3%. And so long as they stay below that level, then I think it will signal to the Fed and to the rest of us that inflation is more of a temporary, transitory thing, and it's really not necessarily a structural thing that the markets and the economic recovery need to be concerned with. So, as I always do, I echo a couple different things. Number one, cautious optimism here. Number two, be aware of what's going on with your wealth building picture, with your financial plan. And three, take ownership of your situation, your financial plan, your wealth building picture, and stay in tune with what is going on. As always, thanks for watching. Hope this is helpful. Comments, questions, please drop them below, and have an awesome rest of your day. Keep dominating. Take care.